S&P. The euro tried to rally. The S&P was rallying. S&P early rally failed. Euro broke. It's very interesting. And now the yen is the pissing post for the moment.
Yeah.
But I think that the dollar ought to be. My ought doesn't matter. The market will tell me. But in my analysis, the dollar should fill the role of the pissing post.
I like that, Ira. That's a good one.
What's that? Pissing post?
A pissing post?
The
Yeah,
wicked
that's where.
post, pissing post.
Yeah, you go to relieve yourself. I learned that. That's what currency trading is. Again, it's a relative. Everything is relative across the board. It's why to me it's a thousand-piece puzzle versus the puzzle that a three-year-old does. So, and you can tell I've been doing a lot of puzzles now that I've been locked in for months. But that's what it's always appeared to me. You have to go where you're going to relieve yourself, which was a classic. Even Tudor and Kovner, and Rich Dennis especially taught that. Go seek out the weakest. So that's and the underlying fundamentals to me of the dollar are the weakest. But we'll see. We'll see. It's got a long battle ahead of it. As you can see, I mean, we come into this resistance and the market respects it, which is good. Market should respect resistance levels, just like it should honor, support levels. And when they give way, then we get more significant movements.
Stephen, I'm not shorting the treasuries because I don't think they're going anywhere.
Oh God, I tried that. What a stupid ass trade that was.
Yeah, Stephen's asking about shorting the 10s and 30s.
Yeah, I understand. I felt like the guy in Dirty Harry. I gotta know. So I threw a soldier or two at it. What a stupid trade. It just, you know what? It became an irritant, and that's the worst of all.
It's just stuck in a 2-point range. It's not going anywhere.
Well, what is really interesting, let's look at the Europeans, and then I'm going to get off because I'm going to go take a run. The
Let me
Europeans,
get to the other page.
you see what's happened here. As the euro has rallied, this time it's dragging the other European debt instruments up with it, which is fascinating for me.
Yeah, there's the Bonos breaking out above their 200-day.
Look at but on the relative basis again, the Italians have really performed well. French have, they're at their opening, but the Italians are 40 ticks higher from their opening, and the Bunds are just hanging in there. But again, if you think the euro is going to hold here, hey, you may as well buy Italian. Look at if you bought Italian, Greek, and Spanish debt, you could get more yield than you're getting in the U.S. 10-year. And that's been the way you can, if you accept the fact that the euro is not going to blow apart.
Oh, you know what? Peter wanted to, we were going to respond to Peter's question about gold and
Oh, all right,
bonds
go. Okay.
before you take off.
Okay. All right, Pete, are you on? Is Peter there?
He might be on a call. He's in.
Okay. All right. So the way that I have looked at gold and bonds for really, I want to say 40 years, I view both of them as a psychological barometer of the market. Now, I think, and what do I mean by that? Why would you buy a 30-year bond? Now, I know that if you're a pension fund, an insurance company, you've got obligations, so you try to do some matches with a return. And yes, I'll get return of my capital, especially if I'm buying a U.S. 30-year bond, because the U.S. has a printing press and they'll meet all their obligations one way or another. But you can't tell me what's going to be in 30 days, let alone 30 years. So you're making a bet, or you're making an investment. Bet is a bad word in that regard. You're making an investment. Okay, I have this. I have these needs. I have to get this much return. It used to be that pension funds had a 7% bogey. But you can't really tell me, and gold serves the same purpose. Gold is an investable store of value, and you're banking on. Why would you buy it? Preferably, I don't want to buy gold because I would like the world to be in order that the central banks, because I buy it as a hedge against central banks failing in a fiat currency world. I can't say that enough. And if you don't understand it, then go watch CNBC and listen to them tell you it's a hedge against inflation and a hedge against inflation, and a hedge against, you know what? Go ahead and listen to it. This is so much more than that because you don't have inflation. So how can gold possibly be up here at $1,820? How can it be? You don't have inflation. Everybody will tell you, and they're more worried about deflation. Well, it's the fear of deflation to me that drives gold higher. That's what it is, because central banks put their entire reputation and credibility on the line in an effort to defeat deflation. And in a fiat currency world, I just want some sense of protecting a store of value, and that's what gold does. So both psychological barometers. One pays an interest rate, which gives people comfort. The other only goes up when there's so much uncertainty and so much fear from people who have wealth, who are trying to say, well, you know what, I got to protect my wealth, and this is how I'm going to do it. I hope to be proven wrong. But, for Pete, they're both psychological barometers, because really, 30-year, let alone 100-year paper. But what are you thinking about? So making a bet, I could tell you that if you're buying a 30-year paper at, 135 basis points today, you're making a bet on deflation. Both gold and bonds are actually, they're plays on deflation. And okay, you can own both of them, but that's to me a Texas hedge. If you should actually be, the gold, I think, is as much a hedge of deflation for the reasons that I stated as the bonds are. So probably the best way is to long gold and short bonds. But they're both merely psychological barometers about people's investment senses. So does anybody want to lock up with that?
Just all you got to do is take a look at the semi-annual chart. It's out of control.
I got something to add in that.
Okay.
Yep.
Okay, so Ira, I have a portfolio management business, and clients, have balanced portfolios and increasingly conservative objectives as they age.
Yep.
So, this paradigm of offsetting equity risk with bonds being an offsetting risk has kind of blown up with overpriced corporate bonds right now.
Right.
Their credit is not priced properly, I don't think. And govies don't have any yield anymore. So it's almost like all they are is a bet on falling interest rates and deflation in a way. They don't like only tips anyway. So this is my thesis. Increasingly, it looks to me like a portfolio. If you want government bonds tips in case inflation starts to increase, they should increase.
Right.
And then gold, because I just feel like it can only have a bid in it anymore as we are locked into negative real rates, and which is the whole problem with these portfolios, unable to get a return out of bonds anymore without betting on falling rates.
Listen, but this is
Oh,
the,
like if, I'm just saying, so like if,
yeah.
I'm not all that bold maybe, but like if somebody was supposed to have 60% bonds in it, maybe I should look at like, 10% of that portfolio, just instead of being bonds or being just tips and gold, kind of a paired trade, and maybe, build from there and just think about it from that point
Yeah.
of view.
Well, Pete, what if you were long tips, short extended duration?
No, I don't, no, I don't want to, I don't want to make a directional bet on interest rates. I'm just looking at the overall direction of things. But I am willing to make a bet that real interest rates will continue to be negative. That the system it can't tolerate positive real interest rates. It can't take it.
100%. So everything that you just said, Pete, is that's the gift. That's the gift from the Fed that keeps on giving. Okay. So you can, talk to me about how great the Fed is, and I'm just not buying it because here you don't have an opportunity to really invest. Okay. You can't buy corporates because they're squeezing corporates down by their own definition. There is no real yield, which is why I keep coming back to the yen. I'm sorry to do this, but I look at the 10-year JGB today, and at least it's in positive territory. Okay, it's plus 2 basis points, but I would probably cite that at least you're at least breaking even if you're a Japanese investor. If you're a U.S. investor buying 10 years, you're certainly buying a negative yield. So now if they force you out farther to the 20 or 30 year, yeah, maybe you're breaking even. We don't know, again, because the data is being very, is so highly impacted right now by all these unknowns. And what the fact is, we just don't know. But this is the gift of the Fed. This is what financial repression is all about. I can't implore people. You want to learn, there's a few articles, they're short, and she writes beautifully. Carmen Reinhart, go Google it, find the articles she wrote on financial repression, and she'll lay it out, and it lays it out. Understand it. That's what the policy is. The policy is to fuck savers. Okay?
I agree. But I just wanted to point out that what I'm saying is that I think I made a rational case for for portfolio managers to allocate more to gold as kind of a substitute paired strategy against bonds, because the whole structure of this bond equity allocation is breaking down. And so the implication of that is that if you're wondering where there could be a massive allocation to gold that's not in it right now, I just laid out the case for it.
Yeah, no, I agree. And, Peter Bookbart did an interesting piece this morning because he figured out where gold would be based on the inflation since it made its high of when Judd and I were young traders at about 880, 890, that the equivalent with the inflation would be 2,600. And it's interesting to think of it in that term. And, I would look at it more on how much fiat currency has been created rather than the inflation, because if I use asset inflation, meaning artwork, automobiles, stocks, then it should probably be much higher. But I'm not going to get into that discussion because, that's for the zero hedge crowd, who lurks always, and looks behind all the bushes and whatever else they want to come up with, the conspiratorial theory. I'm not going to get that. That's not a road that I'm going down. I'm just looking at it as, and I've been consistent for as long as I've been writing Notes from Underground, which has been 10 and a half years, I believe. I've been on this as to explain to people that why gold, I believe that gold was a good investment through this period, through the great financial crisis. And I had really good measures. And probably the best measure I had goes back to November of 2009, when the Chinese were very upset that the IMF sold 2 tons of gold to the Indians rather than the Chinese, because the Chinese were looking to buy it. But the IMF, it was at a certain level. I think it was 7,200 yuan to an ounce of gold. So that's been a really good pivot for me on an international basis, you know, because my look at gold has really been much more against all the currencies. So I was long gold, short euro, long gold, short Swiss, long gold, short yen. And then, you know, really, and people say, well, it's not going up against the dollar. I didn't really care. It had no bearing to me. In fact, I'm actually looking for gold to correct here a little bit if I'm right about the dollar, because gold's already run even against the dollar. But if the room for the foreign currencies to run, I think you'll see some shifting out of those crosses or spreads that have been put on. But I think Pete, your point is 100% right. But this is the gift of the Fed. This is, if you can tell me how to value a bond in today's world, go ahead. Outside of what the last tick is, you can tell me the last tick, but tell me how you're really valuing it. How do you ascertain value across the board? And that's, you know, in Europe, and that's in Japan, and that's in Britain, and that's in Canada, and that's in Australia. How can you possibly value debt? It's all artificially priced because of the involvement of all the central banks. Now, that's just a reality, and the battlefield we're left to play on. So we have to dance around there and figure. So when I said, you know, that was just, I made my first trade this week in the Treasuries. Really, now it's 9 weeks or 10 since when Leo Brainerd was out over that 1 weekend, 10 weeks or so ago, talking about yield curve control. And I said, well, do I want to really play in this? But my sense is that if the economy slows here, and that's why I bought the 2-year, but I put on a steepener, because my sense is this. And the 3-year auction yesterday was really kind of interesting to watch. It didn't really move the 2-year yesterday, although the 2-year is performing better today. But I pose this question. If the economy, because of, again, the huge increase, or is it, let me say instead of huge, significant increase in people with virus, if that leads to a second slowdown, does the Fed go negative interest rates? And I've been in the camp where I didn't believe that they were going to go negative because the impact will be felt in so many ways. And negative interest rates don't work. They don't work. It's, yeah. But if they did it, number one, the dollar would absolutely get hammered. And that will be interesting. And maybe that's why they will do it. But rather than yield curve control, you may as well go negative, because what the Fed is most worried about now is if the economy slows, the vast pool of savings, which is building as people are uncertain about what jobs in the future, they're going to try to force that out. And the way to force the savings out into action, into velocity, into volatility, is to go to negative rates. I don't think yield curve control will do it, but negative rates will. And I'm sure that discussion is taking place because the huge buildup right now in personal savings is causing a great amount of angst at the Fed.
All right, we have a new guy in here, Ira. Here, Steven says, I was a sell-side bond trader 10 years ago. Large bond funds like PIMCO, YMCO, et cetera, pension funds, insurance companies were the largest traders of 30 years. And they do actively trade their holdings. That's why the 30-year bonds whip around so much. I purchase a day trader. Well, you know, I think that from my standpoint, it's equity bonds, and the bonds have become almost irrelevant.
You know what? I applaud this. You know, I have nothing but respect for bond traders. You know, as I lecture a lot, or I used to, up until the last year, a lot at different universities, just as guests. And I always implore students in finance to learn the bond markets, because bonds are such a significant tool for anybody in the global macro realm. So what's his name, Stephen?
Yeah, Stephen. His name's Stephen. He's
yeah. It's quite a resume. I respect it immensely because he's got a vast amount of wisdom, bond trader. So, you know, it's just so difficult, you know, and I'm sure he sees it too. Yeah, you can trade it. Look at, again, bonds are a good trade on any day, but I just, there's no position there for me. And where I was trading the yield curve actually pretty well. I caught the flattener and then I put on steepeners. When the 210 went negative, I absolutely started putting them on. I waited till they went back positive because that gave me at least some definable risk. But right now, I don't. I would love to put on steepeners. I think steepeners are mandatory, except that the Fed is really preventing me. And you've seen the move. We got upward. We get to a high on 68, 69 on the 210, and then we recently got back down to 45. So I mean, there's a trade in there, but it's just not for me. But I'd like to hear from him because he's a man with phenomenal, and this room should love to hear from him because he's got wisdom that you can't get anywhere else, and it's listen and always pick the brain of somebody who's been involved in the bond markets and understand them.
Well, Stephen, I'll go over that with you when a little later.
He's talking about the bonds, spoofs bonds?
He's talking about spoo bonds right now.
Yeah, and you can explain to him if he's new why, and the moves we've caught off of that. Ed has caught some giant moves.
Yeah, huge.
Yeah.
And Bosco's saying here, isn't gold a paradox because a high gold price reflects the collapsing currency system and loss of liberty?
You know what, Bosco, that's a philosophical discussion. Better left to Alan Greenspan and Hayek and Ayn Rand. I don't. There's no easy answer to that. And I'm not looking to dodge it. Oh, by the way, Bernard Connolly has a new book out. So somebody posted it on my website. What's his name? Hold on. I'll give it to you. Hold on. And I'm sure I haven't read it and I haven't talked to Bernard in quite a while, unfortunately, but let me go find it. It's posted on the blog. Let's see. Oh, there it is. Can you hear me?
Yeah.
Okay. Pierre posted it, and it's not out yet, but you can order it, and it's called "You Always Hurt the One You Love: Central Banks and the Murder of Capitalism," and just out.
All right, that's a great name.
It's on. It's at the bottom of my very last blog, and Pierre posted it on July 5th, and actually Owen had told me that he had a book coming, but I have not talked to Bernard, and we used to talk so much. He kind of went to write this book. I'm sure this is this will get into what Bosco's talking about. I'm sure of it without reading it, but knowing Bernard well enough and having hours upon hours upon hours of conversation. But it's a big philosophical question, and Bosco wants me to, but I'm not going to answer it.
Yeah, and as far as book reviews, I'll follow up with The Kings of Shanghai. It was great.
Okay.
And it's still relevant.
All right, but Stephen is a good addition to this room. I mean, this is what this room does: is keep building on people. And listen, you don't have to agree. In fact, please disagree. You know, I can't stress that enough to people. Again, the market will give you validation. I don't need validation from people. I want pushback. You know, tell me why.
Yeah, we don't care if somebody has a different viewpoint at all.
No.
We like kicking that around. And then we'll let the market tell us whether we're right, and we try to ferret out the trades that we seem to.
Okay, I'm not going to challenge anything you say, but you were talking, I was pretty busy earlier this week, so I was kind of catching bits of conversation, and you're talking about a yen price threshold being a huge harbinger of big capital shifts would happen? Would you like go back into that a little bit?
We ask you.
That's Peter.
That's Peter.
Yeah. I know it's Peter, but who's he asking the question to?
You,
you
dollar yen.
Okay.
Dollar yen,
On where?
threshold, how it indicates necessitates a global shift in money, and where do you think it goes, and who has to shift?
Yeah, that's why, and you've been on this as well as everybody, as well as anybody, I should say. So yeah, I'm just starting to see some of that shift, and last night some of the conversation was about, the leak from the White House that they were going to try to break the Hong Kong peg. So of course, what's his name was up dancing in the streets. I'm sure there were a block party down in Texas as Kyle Bass, but that could go either way, by the way, as I read that. That could mean that the Hong Kong dollar pegs then to the yuan and things get very interesting. It doesn't necessarily send the Hong Kong dollar phenomenally lower, phenomenally weaker as, as he's projected. But so phrase your question tighter for me. So I'll give you
Okay. There's I think it was your conversation, or maybe it was Judd too, but that there's a U.S. dollar yen price level that we're approaching where the yen starts to appreciate against the dollar, and that this becomes a trigger point into many different markets. And is that do I have your view right about that?
Well, yeah, Ira was looking at we were looking at the yen the other day because it tried to put it in an ORH day in the futures, ORL day in dollar yen, right? And Ira asked me if it could go, and I didn't trust the pattern because where it was on the cloud and the moving averages. And plus it was into the quarterly pivot on the sheets. So I didn't want to trade it there. I want to see it through the numbers on the sheets to confirm that it can actually go.
Yeah, you know what? And Pete, because the yen, again, I'm going to invoke the pissing post. The yen has been the pissing post when, as Judd would say, that risk on, risk off paradigm, which has been around now for 8 years, really. So risk on, you sell the yen. Risk off, why? And what most people don't understand is when risk off is being taken place, and I think this is old, by the way, and I think it's stale, even though there are still some algorithms built to it. But why that worked during the height of the wind down from of the great financial crisis is that the Japanese have so much money invested around the world. Their current account surplus is huge, and it gets bigger during times of stress because the Japanese have a tendency to repatriate money. But I don't think that they've really been doing that. But there are still some algorithms built to that, and that's what they search for. Almost this morning, it seemed, and I'm glad you asked this question because it almost looks like the euro has stepped in to fulfill that. So, and Judd has caught that over the last, I would say, 8-9 weeks, and when we've been watching this, is that when risk is on, and you could see it this morning, they were buying the euro. When risk goes, when they're taking risk off, they're selling the euro. Again, it is what it is. I don't. Again, I have not existed successfully in this business by locking up with markets and being, you know what? If that's what they want to do, that's what they want to do. That is absolutely fine, and I'm going to respect it because. Number one, I respect my capital. I respect market. Number one, I respect markets, and as a subcategory, therefore, I respect my own capital. And I'll watch it. And I love when these models start to break down, because that's where opportunity is. It happened with the metals.
Yeah.
Because everybody had these same kind of algorithms in the metals. They broke down, and we saw really nice opportunities, right? And I think that's what the platinum is going to do.
Well, yeah, it's like they've wanted to short metals incessantly for years. They've wanted to be long the dollar. I mean, these consensus trades are reversing, and they could go a long way because of that. That's what I'm
Yeah.
thinking.
Well, so when I can get the S&Ps going lower and the euros bucket and start going higher, meaning the euro currency, then we're starting to see, because you got to slap these algorithms hard. You know, listen, I've seen some of the losses. Even Jim Simmons, who's one of the greatest of all time, maybe the greatest of all time, but he's down over 20% for the year.
Yeah.
Why? Because some of these algorithms have been breaking down. It's the same thing with the risk parity world. The risk parity world is great as long as vol is being sold and the Fed has really pumped and all things set up like that. But when it starts to break down, and you're seeing it this year, which is why Dalio and some of these other big ones, AQR, they're not having the years that one would expect. In fact, the global macro discretionary traders are far outperforming them this year, because that's what happens when these algos break down. And, because algos are not really fundamentally driven, meaning that's not what their model works on, as far as I know. I'm sure that they're going to be readjusting.
They're more intermarket relationships, really, right?
Yeah, based on mathematics, they see the correlations and they go with them and they build them into it. So to me, in order for my dollar perspective to be financially successful, I'm thinking that the yen really needs to rally. Now, we've seen the yen rally at different times, as you know. In fact, the risk-on paradigm, let me go to it.
It's trying to get off its butt right now, but it still needs to the futures need to get above like 93.40 and go.
Yeah, well.
So is it going to be the euro, the yen, or you just see it in the U.S. dollar and in the Dixie?
I think the U.S. dollar will across the board, and you're seeing it kind of set up, because even some of the emerging market currencies have really started to at least wake up a little bit, sensing that maybe the dollar is a little vulnerable here. But then it comes and gets saved, and we've seen it, because that pivot on the 200-week moving average has really been a very good pivot, because anytime you test it 3-4 times and it bears out, I'd say that's pretty good. And we all know that it's there. It's no secret, and it's gone through it. But
it's even more important for another reason, is that we got one of our levels there, and now a long-term moving average has picked up that level, so it becomes even a bigger magnet and a bigger closing number.
Yeah. Now, okay, so at the height of this crisis, and I'm talking in financial terms, you go back to March, right? And look at where the yen got to in the futures, up to 98 and change on that one day, okay? But so it had a significant move, and that was the risk off, where everybody was running around, margin calls, one thing after another. Even the gold, if you remember, collapsed. It was down at the same time. It was getting hammered. So there was a lot of things going on. People wanted no risk whatsoever. Now we're getting into a situation we're going, maybe some risk. You know what I mean? And now the risk is, hey, if I think the dollar is going lower, I have to resize my entire portfolio here, because you know what? Now I know Goldman has come out with a little bit bearish dollar, and actually notes from underground. As I say, I got definitively bearish the dollar May 25th, that Memorial Day Monday, following Wolfgang Schweigel's comments. And I've been on this now. There were a lot of, Goldman, all the big firms were, they were all touting the euro at par, meaning, they were bullish the dollar. Oh, deflation. Now they're starting to get into this camp, but I still have not seen enough of the asset turn, the puzzle turn. Now, if the dollar really, if the dollar went down 10, 12, 15% from here, I'd probably say the equity market, meaning the SPOOs, would probably rally. That would be the last leg of the rally, because It's just the way that people would view it because again, what's the algorithm for the dollar? It's trade. But that's false. That's a false narrative. The importance of the dollar going down um, is from a financial standpoint. The trade issue is absolutely superfluous at this juncture. It's not. It's not what the issue would be. It's that a weaker dollar really helps sustain the global financial system because we're on the dollar standard. You know, ladies and gentlemen, as they say at the auction, change your tune. You know, oh, have you seen this? So that's the critical note to it as far as I'm concerned. So that's what I'm waiting for, and that's what I'm watching for. If we can get a pop in the end, you know, Judd has 107.15 on the spot price. I'm not going to lock up with that. That's fine. I just need to see the dollar yen start to weaken because then it would no longer be the risk off, risk on paradigm that has driven this market. And that's all. It's as simplistic as I can make it, and I hope that helps clear things up.
All right. Well, thanks, Ira.
Well, listen, I was in listening for about a half an hour before I said a word because I'm here to learn too. And Steve, welcome aboard, and I'm glad to hear. I hope to hear a lot from you because
yeah, this is his first day in.
Yeah, he has a wealth of information. Believe me, I have great respect for bond people. I don't want to talk to him at a cocktail party, but
Oh, boy.
No, it's just me joking. Really, they're absolutely the one I want to talk to because they understand the world. Okay, I'm out of here.
Okay, thanks.
Right. Okay.